Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio, we have Marvin Loh, Senior Global Macro Strategist at State Street, to discuss the catalyst behind a dramatic change in investor positioning. Marvin, it's great to see you as always. Welcome back to TradeTalks.
Thanks for having me.
It's interesting. The long-term investors have been highly skeptical of the rally that we've seen since the beginning of the year, but that's really changed dramatically in July as investors spent the entire year defensively positioned.
Yep.
What's the catalyst behind it?
Yep, I mean, there's a bit of FOMO to it, for sure. I do think that the data has held up better than expected, and inflation is probably moving in the right direction greater than expected. So with the fact that you had such a great year so far, I think more and more of the institutional investment community is being pulled in to join this rally just because it's very costly to stay on the sidelines ultimately.
Yeah, it certainly is, but isn't it counterintuitive to see a strong risk rally when we're in the face of recessionary signals, and from the rate market at least? Where's the disconnect?
Yeah, I mean for sure. So that's been probably the hardest thing to kind of square the circle this year, is that on the rate side of things, inverted curve, really a 10-year that's remaining fairly well contained, is saying that there's recession concerns out there. Risk asset stocks, credit spreads, they certainly have had an incredible year. Who's right and who's wrong? So far, the risk assets have been right. I mean, we're pushing generally as a market those recession concerns a little bit further out. And there's so much uncertainty out there that it's worth the bet for a lot of people to think that, maybe a soft landing is possible, something that we wouldn't have thought about, 6 months ago.
Yeah, and speaking of the rate markets, how will this impact Japanese investors and their appetite to buy U.S. Treasuries? Yeah,
for sure. So, one of the things that we've been chewing on is really where the Japanese investor is kind of going forward, and what this ratings downgrade recently means for U.S. debt. I think from the former perspective, it really doesn't matter. The ratings downgrade will not have an impact on whether someone buys a Treasury security or not. From a Japanese investor perspective, it probably has very little impact in the short term, but really as we kind of think long term, whether or not the Bank of Japan abandons YCC, just how high yields go in that market is going to define, who that marginal buyer for the Treasury security is. So, if you're looking more long term, after, if you will, 2024, you really want to think about where a good clearing level is for the 10-year and what that means for broader risk assets, because there definitely is a risk that that investor kind of comes back home and looks for other markets, particularly with JGB yields probably rising going into that part of the discussion.
Is there any impact to bank reserve levels in a tighter environment? And what about the Moody's cut in the credit rating of several small and mid-sized U.S. banks?
Yeah, for sure. I mean, we talked about this last time that I was here, so thank you for asking again. I do think that that banking concern is still kind of churning in the background. The Fed is still going through QT. Its balance sheet can be reduced either through bank reserves or this new category, this reverse repo facility, which is less stressful for liquidity in the market. But certainly those reserve levels will continue to go down as long as QT is out there. Deposits are still hard to come by. We've heard that through the earnings season. And then now you have a higher cost of capital because of these downgrades that came within the banking sector. So a lot of the concerns we have about credit creation, about credit stress is still out there. I'd be the first to admit it's taking longer for it to evolve, but there's a lot of liquidity out there. So, when you take a step back, we are going to continue to drain liquidity out of the system, and banks are going to continue to struggle, at least in making the amount of loans that they've made in the past.
Could this sudden shift in positioning, the FOMO trade, if you will, could it serve as a contrarian indicator for the remainder of the year, or do you expect the market to just kind of chug along?
You know what? I think that there's enough liquidity out there. I think that there's enough catalyst to believe that a soft landing is still possible, that it can continue to chug along. Momentum, I've learned over the years, has a much longer ramp than one would expect. It doesn't change my recession view, however. I see it inconsistent that we could have the type of growth we're having, the inflation discussion we're having, without conditions needing to be significantly tighter sometime down the line. And, is higher for longer harder once we get there? I still think that that's the case.
All right, Marvin, appreciate the insight as always. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.